A common question from entrepreneurs raising money is, what type of capital structure is best for my company? To answer that question, it's individually dependent upon your company and its stage of development and its needs. In the broadest sense, there are two types of financing, debt financing and equity financing. Let's take just a minute to consider the broad implications of both. Debt financing is the infusion of capital by an investor in exchange for an agreement of repayment and interest over a specified period of time. Debt is generally backed by collateral and subject to other restrictions the investor may impose to secure their position. Common examples of debt capital are loans and the issuance of bonds. Debt may be an attractive means of securing capital for your company because you're not required to give up equity in exchange for the infusion. However, carrying debt on your balance sheet requires that you have sufficient cash flow to make periodic interest payments, projected resources to pay off principal at the time of maturity, and collateral necessary for securitization. Debt financing is many times not an option for early-stage companies because of lack of positive cash flow. An exception could be debt put in place alongside owner's cash for the purchase price of hard assets, such as plant equipment or real estate. That liquidation price would be sufficient to cover the amount of the loan. Equity financing is the infusion of capital by an investor in exchange for stock in the company. Equity issued to investors in exchange for cash can take many forms, such as common stock, preferred stock, or warrants. Common equity investments are those made by venture capital funds, angel funds, hedge funds. Whatever the agreement structure, equity investors expect a return in the form of dividends and appreciated stock value at the time of company sale or public offering. Equity financing may be attractive because it allows for an infusion of capital into your company without immediate cash obligations associated with debt service. Additionally, bringing in equity investors means that you're bringing in new owners and possibly new board members, which may change the corporate culture. Many times these new owners are experienced business people in their own right and can offer management valuable insights and perspective as your company grows and changes. While equity financing does not make significant demands on cash flow, except when dividends are paid, it can come at a high price. Equity investors take on a lot of risk when investing in your company at an early state, but generally reap handsome returns on their investment at the time of sale or public offering. If an entrepreneur has questions regarding capital structure, they should call us at the Capital Match Point. We deal with these issues every day and are happy to help.